Good afternoon, and thanks for joining us. I'm Bart Edgerton with NACD's Governance Analytics team, and I'll be the moderator for what promises to be a very informative and timely webinar. EVA, the good, the bad, and the complex. I believe it's safe to say that while EVA is not new, it is a fairly obscure financial performance metric, particularly for incentive compensation. However, proxy advisory firm IIS has brought it to center stage. They'll begin including it for informational purposes in some research reports and have signaled that they may include EVA in financial performance assessment screens in the future. We have two executive compensation experts on hand to help us better understand EVA and how it might apply to compensation plans. Matt Turner and Brett Horan, both in Perlmeyer's Chicago office, have considerable knowledge of the history and application of this financial measure. But before we get started, my colleague Sienna Breen of our education team will take us through a few short housekeeping notes. Sienna?
Thank you, Bart. Audience, I have a few housekeeping items to share with you today before we get started. On the right-hand side of your webinar console, you should see several boxes. At the top, you can submit a question to be answered by our speakers during the program, time permitting. If we have a lot of unanswered questions, our speakers may also follow up with you after the program. Please note that if you submit a question, you will be opted in to receive future executive compensation thought leadership from Perlmeyer. Also on the right-hand side of your console, you can tweet live with us using @NACD and @Perlmeyer. And in the bottom right corner, you can download a copy of today's slide deck, register for our next webinar, and access additional resources. You will automatically receive one NACD skill credit if you participate in this webinar for at least 30 minutes. Credit may be applied to NACD fellowship programs, and you can contact fellowship@nacdonline.org for more details. Please note that this is for the live program only. You can download a copy of today's slide deck through your webinar console or at perlmeyer.com using the link on your screen. Also, a recording of this webinar will be available early next week at nacdonline.org and perlmeyer.com. Finally, we will have a few anonymous evaluation questions at the very end of the program, and we would appreciate your feedback, so please stick around at the end of the webcast to answer those questions. And now I'd like to turn it over to Matt to get us started.
Thank you, Sienna. Good afternoon, everyone. Okay, so our agenda should be pretty straightforward. We'll talk a little bit about what EVA is and where it came from. Then we'll answer the obvious question, why are we even talking about EVA today? We'll get a little bit into the benefits and challenges of EVA, and then finally, what boards must do to prepare for what we believe are some changes coming from ISS. So first, what is EVA? Well, EVA stands for Economic Value Added. It goes by other names as well. You may hear it as economic profit, as residual income, economic value, shareholder value added, or simply value added. But in any of these cases, we're generally talking about EVA. EVA is a measure of financial results that deducts opportunity cost of all invested capital, not just debt, but debt and equity, from a company's after-tax operating income results. You can see in the illustration on this page what we typically refer to as the bottom line, the net income line. We've deducted all the costs of delivering a good or service, and we've deducted the cost of interest expense, which is the carrying cost of debt, but we do not deduct the cost of equity explicitly. So it's just not on the income statement. It's not on the income statement, and EVA as a calculation requires additional inputs and assumptions that come both from the balance sheet and from the marketplace. EVA is NOPAT minus a capital charge, and NOPAT is net operating profit after taxes, or just after-tax operating earnings. And the capital charge reflects the carrying cost for all invested capital. The charge is typically calculated as the weighted average cost of capital times the total invested capital, and the weighted average cost of capital is a blend of the cost of debt. Typically, that's based on the interest rate on the debt in stable markets, and the cost of equity. And the cost of equity is typically based on the capital asset pricing model or some derivation of the CAPM, and reflects an expected return on an equity investment. You can see as well that we can get to the same EVA result by taking the difference between ROIC and the weighted average cost of capital, that is referred to as well as the economic spread, times the invested capital. I promise that's the only algebra for this presentation. But to make the point here about EVA and why we have it, EVA is an appealing performance measure because it does hold managers accountable for earning an economic return on the invested capital, rather than merely looking at an accounting profit. A business can be profitable on an accounting basis, but failing to deliver returns that are adequate for an equity investment in the business. So just a little bit of history here. We did algebra on the last page. We'll do history on this page. EVA is, in fact, a trademark term of Stern Stewart. Stern Stewart is a financial consulting firm that popularized the concept of economic profit in the 80s and 90s. It is a financial planning tool that can be used alongside of or in place of discounted cash flow analysis to evaluate businesses, investment opportunities, and strategic planning alternatives. Various studies over the year have shown that EVA correlates very well with shareholder value creation and share price performance, and consequently, because of all the work that Stern Stewart did in the 80s and 90s and the promotion of EVA, EVA has found its way into incentive compensation programs as well.
Matt, this is Bart. Just a quick question. Now, you mentioned that Stern Stewart popularized the concept of economic profit, but was it around before that?
Yes, it was, Bart. The concept of economic profit has been around for a long time. Economists have long recognized the idea of residual income or excess returns above the opportunity cost of an investment, or in other words, the next best alternative for your investment dollars. Back in the 1960s, there was an economist named Nicholas Kaldor. He was at Cambridge in England, and he described something called the valuation ratio, or Kaldor's V, as the market value of a group of assets in excess of its replacement costs. About a decade later, James Tobin, an American economist at Yale, did further research in this area, linking the ratio with market performance, and he kind of coined the term Tobin's Q. So Tobin kind of took Kaldor's thunder, and then about a decade later, Stern Stewart came along with EVA and created a very marketable metric concept that's been used in financial planning and in compensation since that time. Here I'd like to turn it over to Brett, and Brett can talk a little bit about what's going on with ISS.
Thanks, Matt. And thanks everyone who decided to join us today and listen to us talk about EVA instead of spending their Thursday afternoon here in potentially a more entertaining venue watching college basketball. So why are we talking about EVA? As most of you know, the proxy advisors are doing performance analysis as part of the process they go through when they issue voting recommendations around say-on-pay and director elections. With ISS, total shareholder return is kind of the primary performance comparison that they do. ISS then does kind of a secondary comparison using a combination of accounting-based performance measures. Glass Lewis does something similar, a bit more of a black box as to how kind of TSR and some of the accounting-based financial performance comparisons kind of fit into the broader picture that they write around performance. But for the most part, what ISS and Glass Lewis are doing is pretty similar. So why are we talking about EVA again? Well, in February of 2018, ISS acquired a firm called EVA Dimensions. EVA Dimensions is essentially an equity research firm that uses EVA-based performance measures, EVA-based performance assessments in making determinations around relative value. It also does some consulting services. So just to cut to the chase here, ISS voting analytics team, I think we expect ISS to start evaluating companies' performance under this EVA-based framework, which admittedly some view as kind of hocus-pocus black box methodology. At the same time, ISS corporate services team will sell you that black box methodology. So I think there are two kind of operative questions here that we as executive pay consultants are asking ourselves. The first being that many companies interpreted the use of relative TSR plans that make up the ISS pay for performance test as kind of a formal or informal ISS recommendation or endorsement around the use of relative TSR plans. So I think the question that gets asked is, will companies now feel compelled to kind of adopt EVA-based incentive plans? The second question that I think gets asked is, will companies feel compelled to go out and actually subscribe to ISS Consulting Service EVA module to better kind of understand how their own performance on EVA will be viewed by ISS when ISS goes out and does their work after proxy statements get filed. And I don't know if we know the questions, the answers to these questions right now, but we'll kind of see how this plays out here over the next few years. So how is ISS actually using EVA? So ISS has just started issuing what they're referring to as EVA Profile reports. And we'll look at one here kind of on the next page. But ISS is essentially boiling down all of the EVA calculations into 4 distinct measures. An EVA margin measure, which is simply EVA divided by sales, an EVA spread that Matt mentioned a few minutes ago, but calculated as EVA divided by invested capital, or simply the difference in return on invested capital and the weighted average cost of capital. And they do 2 measures they call EVA momentum, which basically turn EVA into a growth measure that ends up getting scaled to either sales or invested capital. These momentum calculations were kind of developed to address the issue created by companies that had years in which EVA was negative and stayed negative, or years in which EVA kind of went from positive to negative. It's kind of an elegant way to scale data that gets affected by positive to negatives. Performance under each of these kind of 4 measures is compared against the general Russell 3000. So as of right now, there's no specific comparison to any type of peer group. When ISS does these calculations, they will make 15 specific adjustments to GAAP financials in calculating EVA. To kind of put the reported results kind of back on an economic basis. We're all used to kind of seeing, the generic earnings reports that companies issue, which kind of provide a reconciliation of GAAP results to non-GAAP data. And it would be nice to see that kind of a thing here with EVA, so that we can all get a better understanding precisely how GAAP reported data is being converted into EVA results. But it's virtually impossible here. We're kind of reporting and tracking EVA using these 15 adjustments would basically requires a second set of books, and that's just not feasible in the work that ISS is publishing around EVA.
Brett, this is Bart. Just want to jump in with a quick question before you speak to this next slide. I know we'll get to some prevalence data later, but just quickly, can you give us a sense regarding these EVA-based measures? Do we know how typically we find them used in incentive plans?
Sure. So jump back to that slide here. So you have these 4 measures: EVA margin, EVA spread, and then the 2 different types of EVA growth metrics. When companies their companies are using EVA incentive plans, the EVA goal is typically expressed as just a simple EVA goal: generate X million dollars worth of EVA. That goal will typically be calibrated using one of these other measures, either EVA margin or EVA spread, or one of the growth measures, just to kind of as a shortcut to the goal setting process. Similar to the way that a company may set an EPS performance goal using some kind of underlying growth rate in EPS. But to the actual question, Bart, you know, and we'll get to the prevalence data a little bit later, but you know, pure EVA-based performance measures are not all that common. But as I mentioned, we'll get to that data a little bit later in the presentation.
Excellent, thank you.
So, how is ISS actually calculating EVA, and you know, what do these adjustments look like? Back in February, ISS issued a 14-page kind of technical primer explaining the EVA at a high level, plus some detail around all of the adjustments that ISS makes. In making all of these 15 adjustments, ISS does kind of impose a set of constraints around making the adjustment. Every adjustment is made to every company. There are no you know, one-off exceptions. Our adjustments are made to the extent that the data required to make the adjustment is reported by Standard & Poor's in their CompuStat financial database. And double entry bookkeeping, you know, the kind of the backbone of all you know, accounting is required. So any type of adjustment that gets made to the income statement requires a corresponding adjustment to the balance sheet as well. So I'm not going to read these 15 adjustments because I don't have any kind of I'm not a glutton for punishment, but you know, individually, I will say that each of these adjustments make sense in that they have implications on economic value and economic performance. You know, some are more relevant than others, and you know, some simply aren't worth the time it takes to read the text here on the page. You know, admittedly, a few of them are reasonably common, fairly common, and do provide better signals around, you know, underlying economic performance. For any given company, including several of my own clients that use EVA or some of its derivative measures. Some of these adjustments are very common and very relevant and very important, including excess cash adjustments, treating leased assets as owned assets, which some of the accounting professionals on the phone know that that's kind of going away under some of the new accounting standards. Tax smoothing, deferred tax adjustments, adjusting inventory to a FIFO cost structure. You know, a lot of those adjustments end up getting made as part of kind of normal performance reporting. So, you know, a lot of companies that may not even be tracking EVA may be making these adjustments in reporting results, either externally, kind of on an as adjusted basis, or being reported kind of internally for performance tracking as well as for incentive compensation. This kind of brings up another interesting question. Is EVA still EVA if you're not making all of these adjustments? I think the answer is clearly yes. You can account for the opportunity cost of invested capital, the opportunity cost for all assets without kind of going through this complex, you know, adjustment process. You know, some of the ardent EVA advocates, you know, may disagree with my position on that, but you know, maybe we can save that debate for another day. But I do think a lot of companies out there, you know, don't go through this, you know, this rigorous adjustment process, but still get a lot of value out of the kind of EVA measurement framework, and actually use kind of what I might call, you know, shortcut EVA or shorthand EVA very effectively, I might add, in an incentive compensation context. So how exactly is ISS calculating EVA? Here we have a simple snapshot of an EVA profile report. You can see single year EVA at the top of the report, and we've helpfully highlighted kind of the four EVA, key EVA calculations. Those key EVA calculations are also repeated at the top of the report, along with the Russell 3000 benchmarks. I'm not sure what else to say about this report other than, you know, ISS has done a pretty good job of giving you, you know, kind of this partial data set to understand how ISS is kind of assessing your performance. The challenge, of course, is determining exactly how ISS is deriving each of these data points, because it's not entirely clear. We can get close, but you're never going to get perfectly close, just because there are a number of assumptions that ISS is making in producing this data set. I challenge anyone to kind of reverse engineer the full boat EVA calculations that ISS is publishing. It's going to be close to impossible. And with that said, I will let Bart go through our first poll question.
Excellent. Thanks. So you should see on your screen now a question that starts at my company EVA, and really looking here for just to understand the ways in which your organization uses EVA, if at all. So you see the questions kind of scroll down the page. So that first one, is it an integral part of our system, our compensation program? So is it something that's heavily used? Not at all, but it's a tool that's used by corporate finance. That third one is not being used, but it's under an evaluation period, looking for potential compensation programs in the future. It's a topic conversation amongst the finance committee. And then the last one, see down the bottom, has not been really part of any meaningful discussions other than preparing for ISS changes. So why don't you take a few moments, reflect upon which ones are representative of your organizations, check the boxes, and press submit. We'll look at the results in just a moment. If we look at these, I think that pretty interesting. I think that the top vote getter certainly down there at the bottom, that not really been part of many meaningful discussions other than prepping for ISS changes, followed by conversations at the committee level, and then used a little bit more maybe by corporate finance and in some of our compensation programs. So I think there's some interesting background information there, and we can move on to the next slide.
Just 1 second, Bart. Just a couple of thoughts about those results.
Oh, sure.
We don't need to pull them back up. I'll just make a couple. There it is. These are interesting and not surprising, I think, to us that just over half are maybe taking a passive-aggressive stance here with respect to the use of EVA. I think that makes sense. The point that it's not in the compensation programs but a primary tool used by corporate finance, that response is a bit of a foreshadowing of some data that Brett's going to share later around the views of EVA we're seeing from managers and directors. So interesting results, and I think not overly surprising. All right, so I think this is me again. Yeah. So just to pause for a second, reflect back on EVA. I want to underscore what I think I was implicitly saying earlier, that when you think about EVA and the benefits and challenges, there clearly are some benefits. The popularization of EVA can be credited with a great deal of an awakening around balance sheet management in corporate America, and that's all to the good. So EVA has been strongly aligned with shareholder value creation. It's been successful at getting companies to hold managers accountable for balance sheet management. When you make those adjustments that Brett talked about, or at least maybe a handful of the most important measures, they can make a lot of sense and correct for accounting distortions and help send better signals to managers in terms of decisions they need to make to improve performance of the company. It can be scaled to better compare to companies of different sizes up to a point, and that's where those scaled measures that Brett talked about come into play. And it can be a very useful tool for corporate planning as well as financial goal setting. I'll pause here and say, when I think about the clients I work with today, I have about 1 out of 12, 1 out of 13 of my clients that are actively using EVA and incentive compensation, but about half are explicitly using EVA modeling as part of the goal-setting process itself. So it can be a very useful tool for that. That being said, there are clearly some drawbacks. And number one, if the eye chart of the adjustments to EVA wasn't enough, I'll point out that there is some complexity with EVA. It's a simple concept, but in terms of how it actually gets implemented, it can be quite complex. Number two, it lacks familiarity We'll see some data in a minute about the prevalence of EVA and incentive compensation plans, but if it's not a very popular measure, you can't expect that your incentive population is going to be real familiar with the measure, and so that lack of familiarity creates a bit of a hill in terms of implementing an EVA-based incentive compensation program. There's been a bit of a history of poor implementation of compensation plans as well, and it doesn't have to be that way. EVA as a standalone measure can be used like any of the other incentive or financial measures as a centerpiece measure, but we've tended to see EVA used in plans where the goal setting is mechanical and on autopilot, or it's only EVA, there aren't complementary measures used. And in most of these cases, in my experience over the past 25 years, I've seen the plans kind of end up hitting a wall, crashing and burning, and needing redesign because they just couldn't be put on autopilot the way they were. And part of that is due to the fourth point here, that oftentimes EVA is viewed as a panacea by true believers, that all you need is EVA. And the fact of the matter is, when it comes to incentive compensation, there are other factors that there's no single measure that's going to be adequate to capture performance evaluation for a team of executives, and we don't think that EVA fits that category either. And the final point here, which I think has all of us kind of looking and making sure we understand what's coming around the corner, is that for comparative purposes, for broad-based comparative purposes, EVA really isn't any better than any other set of metric combinations for evaluating executive compensation, but it comes with that additional complexity and the additional black box phenomenon that a dollar of EVA may come from different sources. We're not quite sure from looking at EVA where it comes from. So there are some drawbacks that we need to be aware of.
Matt, this is Bart just jumping in with a quick question again.
Yes.
Just at the end there, you had mentioned that EVA is no better than other metrics. Do you mind just providing a little bit more information around specifically what you mean by that?
Sure. What I mean is, if we step back and think about the advent of ISS pay-for-performance tests, I think everybody can agree it's important to quantify and measure pay-for-performance. When it comes down to a broad-based test that applies across thousands of companies, we run into all kinds of problems. First, we look at relative TSR, and the argument for relative TSR is, well, it really is the common denominator for a publicly traded company, that you need to deliver shareholder value. So relative TSR, even though we might be measuring too short of a time period, and even though it might not be fair because we're not thinking about the right basket of alternative investments, relative TSR is at least the common denominator everyone agrees with. But then we back up and say, well, yeah, but some companies, it's important to kind of take a step back and look more line of sight. What about the underlying financial performance? Well, ISS and Glass Lewis are doing that. But we also have these disagreements that, well, they don't apply in the same way to every company, and maybe some measures are more important than others. And then we say, well, what about EVA? Well, EVA kind of consolidates growth, profitability, and capital efficiency. So it's capturing in a single measure a lot of insight that you need two or three measures to get, but it creates kind of that black box that we don't know where that additional EVA came from. And at the end of the day, what we're trying to do with pay-for-performance evaluation is get comfortable that our executive compensation programs are delivering rough justice, are aligning executives with shareholder interests, and are serving those shareholder interests. And a single measure, any single financial measure, is going to come short. So whether it's EVA or some combination of other measures, you're going to come short, and EVA just comes with the additional complexity and black box phenomenon. So let me give this back to Brett to walk through some data on prevalence and such.
Thanks, Matt. With compliments to main data group here, we have some data on the prevalence of a few common performance measures within the S&P 500. As you can see, prevalence of EVA, which is the lowest line on the chart, the blue line, is pretty low. Generally, less than 5% of companies in the S&P 500 are using EVA kind of anywhere in the overall incentive measurement framework, whether it's short-term incentives, cash-based long-term incentives, or equity-based LTI. And you can kind of see how the prevalence of EVA there at the bottom of the chart compares against some of the other common performance metrics that we've seen, whether it's EBITDA, ROIC, the bucket that I call all return measures. So whether it's ROIC or kind of return on assets or return on tangible equity that you might see for a financial institution, and then EPS, which for a lot of folks ends up being the number that they look at kind of at year end and see how it compares against the prior year. Not that EPS is a preferred performance measure, but it does capture the attention of a lot of investors. The point was made earlier, but I just want to kind of underscore it and reiterate it one more time. Whatever measure you pick, or whatever measures a company uses for incentive compensation purposes, it ignores a key question that's related to goal setting, because as many know, goal setting is as important, if not more important, than measure selection in terms of determining how much pay ought to be delivered for a given level of performance. And so when we think about goal setting, companies can incorporate economic profitability into the question of goal setting, which is, as Matt pointed out, several of his clients use kind of economic profitability in the corporate budgeting as well as the goal setting process. So while companies can use more conventional performance measures, but they may in fact be using kind of economic value-added concepts in the goal-setting process. So, in sum, we don't find EVA to be a commonly used incentive plan performance measure. And as we show on the next page, we don't really find much investor interest in EVA either. This data is from a quick poll survey that Meyer recently ran to kind of better understand what companies were hearing from their own investors about economic value added. And as you can see, roughly 70% of respondents have not heard anything about EVA from discussions with their own investors. And again, I think this kind of data set speaks to one of the drawbacks that Matt mentioned and Bart drilled a little deeper on. EVA works well as a summary, kind of overall performance metric, but it really falls short when you think about EVA's ability to kind of tell a nuanced and holistic story of performance. And I think that as a summary performance metric, I think that's why ISS can look at their current kind of scorecard and essentially collapse it into this kind of EVA scorecard. When you think about the discussions that companies have with investors, investors are looking for a much more complete performance story. They want to know what top line growth looks like. They want to know trends in operating margins and where operating margins are expected to go. They want to know what's happening with inventory and inventory turnover. Looking to understand expectations related to new capital investments. It's that kind of balanced scorecard of measures, I think, that tells a much more holistic story of performance, and we think has better line of sight to management operating decisions. And so that's why we think EVA doesn't necessarily get much play or get much attention when we think about the process that companies go through in selection and identification of performance measures.
Hey, Brett?
Yes, Bart.
This is Bart. Yeah, just a question. I think what was interesting to me was probably that top set of responses, that 10% of management and I think 4% of board responded that, yes, there's broad support for our investors in EVA-based incentives. Was just wondering what you think might account for that.
Yeah, so good question, Bart. I think when we look at the way that board members responded to these questions versus how management has responded to these questions, I think a big driver of those differences is how EVA gets marketed and how EVA gets discussed. A lot of things there are a lot of discussions occurring, whether it's with investors or whether it's with service providers or outside consultants, that management is that management's having, that the board, it just doesn't necessarily register with the board, and so management may hear much more about EVA than directors will, and so that's why I think you tend to see a much more notable difference in the way that management has responded to some of these questions.
Thanks, I appreciate it.
And with that, I will pass it back to Matt.
Thanks, Brett. Okay, so I want to walk through a few examples here of EVA and incentive plans, and I'll preface this by saying this is not the only way that EVA can be used or has been used in incentive compensation plans, but I'd say reflecting back over the past 20, 25 years, when we've seen EVA implemented in incentive compensation, this sort of banking plan I'm going to describe has actually been fairly common. In this example, what we have is a plan that's based on a % of absolute EVA and a % of EVA growth in a given year. And an executive receives a payout based on that change in EVA and the amount of EVA that a company is generating. But it's important to note here that EVA on a year-by-year basis is actually a pretty volatile measure. What I mean by that is your planned number versus your actual number will vary more so than we're going to see for other metrics that we use in incentive compensation. So think about sales from year to year. You plan out what sales are going to be in the coming year, and your actual sales vary from planned sales. They don't vary by a whole lot, but as we move down the income statement, each successive metric, as we move through midstream income measures like EBIT or EBITDA, down to net income, the measures get more volatile. And the fact is EVA is actually below net income in calculation because we're additionally subtracting out the opportunity cost of equity. So EVA is a volatile measure. And in fact, in many years, it can be negative for a lot of companies. So this banking plan was created to kind of smooth out the incentive payments that will come from EVA. And the way this works is we calculate the contribution to a notional bank account in a given year. The amount is credited, and 1/3 of a bank account is paid out as an incentive payment in a given year. And the following year, you do the same thing. You pay out 1/3, and it just keeps moving along like that. In this example on this page, you can see that the company's EVA over several years is actually fairly stable and growing. In fact, there's just a constant G applying to these numbers, and the change in EVA is growing slightly each year as well. And you can see that the resulting incentive payments, the green line, are fairly close to the earned award on an annual basis for the two EVA metrics that we're using. So when business is economically profitable and stable, the banking plan works fairly well. But as I said, EVA can be volatile. And so you can see in these additional examples that when we look at the way the payouts occur, yes, indeed, the banking approach here smooths out the EVA payments. But what happens is we start to highlight some potential issues with a plan that has set up its goals on kind of autopilot and is set as just kind of a percentage of a couple metrics over time for a volatile measure. One is that a few bad years of EVA performance can severely deplete a bank balance. And when you think on a practical level about recruitment and retention, when you have a bank that over the next couple of years is going to pay out lean results, you have an issue in terms of managing your talent. The second is as a company grows or as a company changes in size, you're going to have to keep an eye on those sharing percentages and from time to time change the sharing percentages of those metrics that you're using in the plan. So if it isn't clear as well to these concerns, the other point is that this is a bit of a complex incentive plan design. We typically do not recommend these type of designs unless there's an awful lot of readiness and leadership commitment to a plan like this.
Hey, Matt, I just want to make one other point on your on your page 19. I think there's one other interesting point is that when EVA was very popular back in the the mid 90s and late 90s, and those EVA bank balances started going down, I think that's kind of the time period when companies kind of stepped back and said, is this traditional EVA banking plan working for us in terms of how is it driving the behaviors that we wanted to drive? Do you have any thoughts on that question?
I think that's true. I mean, in a more general sense, and again, credit to Stern Stewart and the EVA, they call it the EVA revolution, with kind of creating an awakening in corporate America about some things around management of investment that really got a lot of good attention. Many companies that put EVA in place found a lot of low-hanging fruit. They found that changes in the way they managed working capital, scouring their fixed capital for non-productive assets and getting rid of those assets led to a lot of early gains in EVA. And that was all great, and shareholders should be thankful for that good work and creating that insight at the management level. But as you start kind of hitting the wall and the easy stuff goes away, the metrics you're using to measure success get much, much tougher. And in my experience, they haven't changed fast enough to recognize the economic circumstances. I think that is also applied to EVA incentive plans as well. So good point, Brett. Thank you.
Yep.
One other thing I'll mention before I turn the page, and that is, if we look at the pattern of EVA changing from year to year, we can say $1 of EVA is good, a loss of $1 of EVA is bad. But what isn't clear from any of these examples is what's driving the change in EVA. Is it because they're growing the top line? Is it because they're becoming more profitable and increasing margins? Or is it because they're managing capital more efficiently? We don't necessarily know, and I would submit on a management level, those answers are really important. And oftentimes in business situations, one of those three levers is more important than others, and you may want to emphasize those points. So the next page is an example of a way to structure incentives that captures EVA or recognizes economic profit without using EVA per se. So in this example, what we have is a matrix of return on invested capital arrayed against cumulative NOPAT, or total NOPAT over a 3-year period. The executive earns a number of shares, maybe the PSUs, equal to their target times the multiplier in the matrix box. The horizontal is focused on profitable growth, and the vertical is focused on capital returns. And we know those are the key inputs to economic profit. So if we are setting goals and setting the pay scale here with respect to our known cost of capital, then we can be paying attention to EVA or economic profit without using EVA as a specific measure. And in general, what we can do is we could modify this matrix to better match up with our own business circumstances. We could we could make this place greater emphasis on profitable growth. We could make it place greater emphasis on getting economically profitable on the ROIC scale. So there are different ways that we can tweak this. In fact, we could even replace NOPAT with sales, since ROIC is capturing profitability at some level anyway. So in our experience, the idea of EVA is really important, but it isn't necessarily to use EVA in your incentive plans to pay attention to economic profitability in your incentive plans. I guess that brings us to our next question. Bart, you want to walk us through this?
Yeah, would be happy to. So thanks for that. I think it provides a really solid basis for understanding EVA and how it can be used. So to that end, audience wanted to give you a chance to just let us know how comfortable you are with using with your executive compensation program when ISS begins including EVA in its assessment. So how comfortable are you with the current compensation program when some of the changes are made? A couple of answer choices here below the scroll bar. So you see the first one, it's no problem at all. We highly confident. The second one, feel good about it. Moving down, the performance measurement framework needs to be changed a bit, and then the last one, still rather confused. So 4 answer choices here, kind of going from most comfortable up top to least comfortable at the bottom. If you want to make your selection in the next couple of moments and press submit down there at the bottom, give you just a couple more moments to think this through and make your selection, and we'll go ahead and look at the results right now. Okay, just scrolling through these, it seems that really just looks like most folks are bunching in the middle, about 10% up there, really highly confident, and then in the middle, most of about 75% of the folks with about 13% of us still pretty uncomfortable. But I think that's a good gauge, and you turn it now back to the presentation.
Yeah, just real quick, a comment on those results. I think I might have expected the middle bar there to be higher than 41.7, maybe around 50 or 60, and the next bar about we need some updating to our performance framework. That's a little higher than I might have expected as well. So that's interesting. Maybe it's part of understanding that this EVA framework is going to create a new lens for looking at systems, and I guess that's good to start to turn some attention there. So I want to be mindful of time here, so I'm going to move a little bit faster, but I just want to cover what I think it takes to be successful in implementing or maintaining an EVA-based pay and performance framework. Because if you can check the boxes, EVA can be a very useful measure. The issue is that you really need to check all of these boxes. Number one, there's got to be leadership commitment. Your CEO needs to be behind the idea of measuring EVA and using it in incentive plans because it takes a tremendous commitment within the organization. It has to start at the top. Number two, adequate internal financial reporting systems. You now have to put balance sheet inputs into a metric you're using for incentive compensation, typically not just at a corporate level, but at a unit level as well. And so you need to make sure your systems can report information in an adequate fashion. Deep participant education. I mentioned this is not a measure that people walk around with in their heads that they're familiar with, and so when you think about your incentive-eligible population, you need to prepare for education, and there needs to be ongoing education as well. Finally, broad agreement on key inputs, making sure you're comfortable with the EVA definition. That includes both at the management level and at the board, the comp committee level. Robust goal-setting process. It's not good enough to put EVA on autopilot. So all the hard work you're doing on setting goals with respect to ROIC and earnings growth, all of that hard work needs to be put into EVA goal setting as well. And then finally, supportive and knowledgeable compensation committees. Measuring, managing, talking about EVA, evaluating the management team on EVA is different than doing so for EPS or EBITDA or sales growth. And so you want to make sure that your compensation committee is comfortable with EVA and what EVA performance means for your company. So what should you be doing? I think these points are going to be a bit self-evident, but let's just run through them quickly here. As you did with the advent of the relative TSR, pay for performance tests in ISS, and the financial scorecard measures that show up in ISS and Glass Lewis, right now you should be starting to understand your company's EVA performance as best you can, given the EVA definition that ISS is using, and make sure you're ready for that ISS scrutiny. Review your current compensation programs, the performance measurement framework. Make sure you've got a good link between your incentive framework and your business strategy and economic context. So it sounds like some of you are thinking, well, let's go back and take a look at some of these things because maybe there's some work to do. Number three, and this is really important, review your goal-setting process and ensure the concept of economic profitability is being given sufficient attention. That is, setting goals with respect to your cost of capital. It doesn't mean that your threshold needs to be above your cost of capital in any given year. It just means you need to be mindful of where you are economically profitable and where you are not, and what you're going to tolerate in terms of unprofitability in terms of your incentives. And then finally, review your disclosure narratives and ensure there's no blind spots for criticism or lack of concern about the concept of economic profitability. And then just to wrap up here in terms of key takeaways, it's our view EVA or economic profit is an important concept for corporate planning, valuation, and for some, even incentive compensation. Companies need to be fully familiarized with what's happening with ISS and EVA and the pay for performance evaluation, and be prepared to engage investors and other stakeholders on this frame. And then finally, if you do not change your compensation programs to include EVA, don't worry so much. You're not alone. It's not a very prevalent measure. It's just important to be aware of economic profitability. And with that, I'll pause, and I think, Bart, maybe we've got some questions we can get into.
Yeah, we've had a good number of questions coming in, so I'll give these to both of you, Matt and Brett. So the first one, do you see EVA, the EVA model being less used in a low-interest environment?
No, I don't think that the prevailing macro interest rates necessarily drive more or less interest in EVA, mainly because I think the principal issue here is that there's always going to be an opportunity cost on an investment, and it's always going to be important to pay attention to that opportunity cost. And we've had very low debt rates for a very long time now. But the calculated cost of capital, even using conservative models, still says you've got to return 5, 6, 7% on a weighted average basis to your investors, and that's not a trivial amount. So I don't think the interest rates are going to drive to any extent greater or less interest in EVA.
Agreed.
Excellent. So with one question from a director at a specialty bank. So I'll ask the question as they asked it, and then I have a slight extension. So what their question is can the concepts of EVA be applied to a bank, and was wondering how the analysis changed. So I think it'd be helpful to address that, but also just looking across industries, how the concepts or the analysis might need to change for as you go across different industries.
That's a great question. Brett, I'll turn it to you in a second, but I will say that financial institutions, I think, present a set of unique challenges when trying to implement an EVA program, one of which is that debt is used in a very different way in financial institutions than it is for a bricks-and-mortar factory making widgets. And so I think you need to be careful. And the second point is organizations where you have a mission that has to pay an inordinate amount of attention to risk of capital creates a complexity as well that makes EVA somewhat difficult. I don't know if you've got anything else you want to add on that, Brett?
Yeah, so on the with the financial institutions, I think they EVA for a financial institution simply becomes the difference between cost of equity and return on equity. They don't consider the cost of debt because there is really no debt for a financial institution, right? It simply comes down to return on equity and cost of equity, and that's essentially what EVA becomes. And in fact, now that I think about it a little bit more, I think that's what ISS may actually be doing with EVA for financial institutions. It simply ends up being an equity calculation only.
Okay, and one or two more I think we have time for. So this next one, wondering how you can allocate EVA across key functions to be used in compensation, not just for the CEO, but for the senior leadership team. And kind of the question is around whether or not you can do that at all, or if it's better to hold accountable all leadership team kind of as one group to the company result.
You can calculate EVA of course, at the corporate level, and then typically you want to do it at a unit level as well. And the question becomes, well, how do you apply EVA to a corporate staff? And I think, Bart, to your point, the latter suggestion you have is really the more popular, and I think the more appropriate way to say that if you are part of an enterprise corporate team, you're responsible for and you're being tied to the enterprise-wide EVA results. And then when you get down into the businesses, of course, you can look at EVA on a business-by-business result, and it's pretty much parallel to the way you take a look at earnings contribution as well.
Thanks. So I think maybe one or two more. Have a couple of questions come in just asking about different comparing EVA with different metrics. And one was which is better for executive performance comp, TSR, or EVA, and you can take that as is, or if you'd rather speak about maybe some of the relative benefits or when one might be preferred over the other.
Let's take that one, Bart, because that question actually reminds me of a point I don't think we made quite as clearly as we had intended to, and that is when you think about measuring performance of an executive team, on one hand you've got line of sight financial performance measures that people can understand and calculate pretty easily. On the other hand, you've got the share price performance that not only takes into account all kinds of firm decisions that are less tangible around managing the business, but also takes into account all kinds of information that's exogenous to the firm. And what the EVA definition tries to do is kind of move from one side of the spectrum towards the other side, towards explaining share price performance. It does a nice job of doing that. But the question is, if you're using basic financial performance measures that people understand, and you're using share price, which just about every public company that has an executive compensation program is in terms of the use of share price, do you really need to use EVA? You know, what are you gaining from a financial measure that's a bit more complex and a bit more black box if you've already got share price and you've got those financial measures?
Excellent. So one more, I think, last one. Hopefully it's quick to end it in the presentation, which I think has been fantastic. But wondering if you have any quick comments on capital intensive versus capital light companies or industries using EVA.
Yeah, and Brett, I know you know this from a couple of clients we're working with right now, that capital-intensive companies, I think, are going to tend to gravitate towards EVA more so than non-capital-intensive companies, because typically when you move from no awareness to full awareness of economic profit, capital-intensive businesses are going to tend to have more low-hanging fruit. At the other end, you think about professional services firms. EVA is really hard to calculate when you know all of the assets of creating value really are the retained talent of your team. It doesn't really hit your balance sheet in a way that is comparable to bricks and mortar.
That's right. I think, you know, with an industrial company, you can easily look at assets on the ground, you know, in a piece of equipment or a property or a big plant, and say, are we earning an economic return that, you know, fully reflects the carrying costs of both debt and equity on that asset? And so EVA, I think you find a lot of industrial type companies relying on EVA for corporate budgeting and for incentive compensation. And to Matt's point, it doesn't necessarily make a whole lot of sense in a professional services environment or asset light industry where where the assets where the assets are less tangible.
Well, thank you both very much. So Matt Turner and Brett Horan, both from Pearl Meyer Chicago office. Really appreciate you being with us here today. I'm going to turn it over back to Sienna for a few final housekeeping details. Just a couple of notes for those of you on the line before you go off and enjoy your days. Thank you so much for joining us.